Today we'll be taking a look at the stocks in my portfolio and talking about what I plan to do next with my portfolio now that the stock market is hitting fresh all-time highs. Take a look at the S&P 500 on a daily chart, tapping into that all-time high, and look no further than the Qs, which are putting in new all-time highs as we speak and as I record this video. So in today's video, I'm going to give you my concept of overall what the markets are looking like right now, why I'm still a bull on this market even though we have hit all-time highs, and the stocks in my portfolio and what I'm doing with them. All I ask as we get started is hit that thumbs up button if you're new to the channel, subscribe, and let's jump right in. So as I mentioned, the NASDAQ is sitting at all-time highs, which is pretty remarkable considering everything that's gone down in the last year. In fact, here's a list of some of the reasons why I think that we've made it back to all-time highs from a macro perspective. Check this out. First, what took us away from all-time highs in the first place? Well, it was the worries about tariffs. And what have we seen since then? Well, if you are not a big fan of Trump, then you've heard the taco statement, right? Trump always chickens out. And if you do like Trump, then you say, hey, look, he's a businessman negotiating. And so the point is, the tariff lows where we saw, oh my gosh, we're going to see this isolationist kind of move and the US is going to trade with nobody. We've seen that really walk back from the edge of the cliff there. And we've mostly seen, we've seen a trade deal with the UK. We've seen what looks like deals are going to happen. Most Fed officials are in consensus that we're likely to get rate cuts this year, right? Depending on how many, that's up for debate. But the point is, rate cuts seem to be the next move for the Fed. That is stimulative. We also have earnings in the United States holding up pretty strong relative to what people thought they were. And we see a labor market that seems to be holding up okay. So the soft landing story seems to be back on the menu. And so the NASDAQ, as you pointed out, back to those all-time highs. So now that we've gotten the macro out of the way, let's talk about the positions that I have in my portfolio currently. And I'm going to walk through some of my active trades on the options side, as well as some of the stocks that I'm holding currently, following everything that we've seen in 2025's crazy, chaotic year so far. First up on the chop block is going to be Nvidia, which I'm sitting on some pretty good gains on this stock right now, up $20,000 on this stock, which kind of came out of nowhere recently. We've had a really strong bounce back in the price action on Nvidia. And what you can see here is that the big tank that we saw in April was met with some serious buying the dip that took place to follow. The thing about semiconductors in general is that they are very, very sensitive to the global economy. If you think about it, similar to how oil demand might go up in a raging economy, chip demand also goes up in a roaring economy, not just domestically here in the United States, but globally. If there is a huge demand for AI, that is usually stemming from strong economies that are demanding strong amounts of AI. And so Nvidia is very sensitive to what we saw in the tariff worries, and so naturally the stock price dropped pretty substantially during all of that stuff. However, I'm a long-term fan of the company and have been waiting for a while to add some shares to Nvidia, and I was able to do so here. So the question is, am I buying more, am I holding, or am I selling Nvidia at these now all-time highs for the stock? The answer is I'm holding steady. I don't want to add more because, again, this is a very, very excited kind of stock market darling, if you will. And I do think that we are starting to get a little bit stretched in terms of short-term price action. But I do love the stock. And so if we were to see some pullbacks, perhaps, in terms of where we could go with the stock, if we were to pull back into the 120s, 115, somewhere in this range, I'd be more willing to add more shares to my positioning here. But as it sits, I already have 500 shares of Nvidia, and I'm not in a hurry to add a huge amount from there. The next stock on the list is Google, which, although it has not been the most impressive performer in my portfolio with all the bounce back that we've seen in recent times, Google is one of my favorite stocks and has been for a very long time. Here are a couple things that I am very excited about when it comes to Google that go beyond just search. First and foremost, all the rave recently is ride-sharing stuff, and Waymo is taking over by storm in certain places like San Francisco Francisco, and all over the rest of the country. I think that over time, we are going to see these self-driving, autonomous driving, robo-taxi sort of things take place in more American major cities. And so Waymo, I think, is a big winner in this, as they are pioneering alongside Tesla and Uber. Additionally, I'm a big fan of the platform we're all using right now, which is YouTube. YouTube has a lot of growth, and more users are joining the platform, more and more creators are joining the platform, and YouTube is a keystone player in the portfolio of Google. Google's also involved in all sorts of AI things, like for example, I've been using this new platform called Notebook.lm, very cool, which is owned by Google. And the Google Suite is a incredible tool set that all of these things are areas of growth and areas of value to the portfolio that is Google. So beyond just search, which I also don't think is dead, and I still think people will be doing Google searches for many years to come, is a very strong overall setup for Google going forward. I also, of the Mag 7, like Google's financials. Let me show you. So I've just pulled up Google's financial data on the stock box, which is the tool that I often feature in my videos. By the way, if you'd like some information, there's a link in the description down below to where you can explore Stockbox in its entirety. So if I take a look at the financials report, what I like about Google is we can see on the green revenue bar chart here, we have steady growing revenue, steady growing net income for this stock, and widening profit margin on this business. Just looking at the income statement, this stock to me looks really awesome. But on top of this, we have a forward PE ratio that is, in my opinion, relatively appropriate, around 18.6. It's not so bad compared to some of the other Mag 7s, which are priced more expensively than Google. So why is this stock on a relative basis? You know, if we take a look at just the PE ratios quickly of something like, let's take a look at like Amazon, you can see the forward PE for Amazon is around 34, 35 range, and a PE ratio in the 30s and 40s. If we take a look at for example, Apple, which, is a stock that I've been critical on this channel, it has a forward PE of 24 and a PE ratio around 33 as of the last reported quarterly earnings. So you look at this and you say, okay, so why is Google then getting a less favorable valuation? And the reason for that is because people are very scared of the search engine business, which makes up a huge, I think it's like 55% of the income of Google comes from Google search, their ads business. And so that is being threatened by all of these different new chat AI bots and things like that. But my personal view is that growth can coexist for both these new things coming, and I think more and more Google searches will be taking place. And so I think that can grow alongside all the demand for AI. And so I like the stock quite a bit. If we take a look at the earnings per share actual versus earnings per share estimate, just taking a look at the reported earnings relative to forecasts in the recent reported quarters, you can see all 4 quarters in the last 4 quarters, we have seen beats on the earnings per share actual number. You can see we've got a rising earnings per share trailing 12-month chart here that looks pretty solid as well. And like I said, if you want to explore the stock box and all of its features, there's a link in the description down below. So overall, I do like the idea of continuing to hold Google in my portfolio based on what we just got done discussing. Now, as you probably just heard a second ago, I'm not a huge fan in terms of the stock price and the stock valuation of Apple, which is another, of course, Mag 7 company. It's a giant, and they build some incredible products. But I've been critical on my channel here recently about Apple. In fact, I'll link in the top right hand of the screen right now one of my previous videos if you want to deep dive on Apple with me. But basically, long story short, I don't love the lack of innovation. I think the stock price is very expensive. So when we take a look at Apple, I do own some from the sell-off that we saw in April. I ended up getting a pretty good buy on Apple. However, I have since sold covered calls on my position. Now, covered calls, if you're not familiar, I shorted calls against 100 shares of the stock that I own. When you sell a call, you are essentially promising to sell someone else the right to calls at a certain strike price before an expiration date. In which case, I sold the, let's see, where is it? It's the July 3rd 210 Apple calls. I'm currently sitting up $316 on this trade with a max potential profit of around $360. My plan with this was that if Apple kept going up, I would get called away from the position. But despite many other stocks rallying, Apple continues to sort of be this bore in my portfolio. And my plan is to continue to short calls or sell covered calls against my shares until I get called away from the position. And this allows me to hold on to a stock that I do like the products of Apple, and I don't mind having some Apple in my portfolio, but I also can collect some income or generate income by shorting calls against my position. Part of the reason I do this is because I don't see massive upside, and if I did see massive upside from current levels, I probably wouldn't be short the calls. Another stock that I've done really well on, but also really bad on, is Robinhood. Now let me show you Robinhood. I'll pull up the stock ticker, and when I say really good, obviously this stock has been one of my best purchases this year. I bought Robinhood during the market sell-off and actually am sitting on a 105% gain. Now, where I've not done so well is selling calls against my position, as the stock has skyrocketed so much that I've tried to short calls, in which case I've already rolled this once before, but I sold the $85 strike price calls against my Robinhood shares, and this thing has just skyrocketed right on up to the strike price within a few short weeks. Now, I do still have a couple weeks to go on these calls, and so if this stock rallies from here, it will be likely that I will be called away from my position in Robinhood. And I did collect a payment for doing this, so I'm getting something out of shorting calls, right? Obviously, I get paid a premium, but this will have meant that I left some money on the table with this stock if it keeps rallying past the strike price. However, at the time of recording this, we are seeing a little bit of a dip in the stock price intraday, and if I pull this up on like a 1-hour chart, you can see we did go right up to that strike price and start to pull back. So it's possible that we'll see in the next few weeks Robinhood relax, go sideways or slightly down, in which case I'll be able to keep my 600 shares. But if we do rally past this, I am likely to let this stock go for what is a 105% profit, which is pretty incredible. I'm definitely not complaining with this kind of return in just a few short weeks. It's definitely one of the best stock trades that I've ever placed in terms of a percentage gain and an absolute gain, sitting on a really nice profit on Robinhood. Next up on the list is Home Depot, which Home Depot has been kind of a boring one in my portfolio, but it's a stock that I never mind buying a little share in when the stock market is down. And so I did buy some Home Depot, and this one continues to sort of just be a standard, slow and steady stock to be in the portfolio. Next up is Amazon, which has been doing pretty well here. It's still a little bit of a ways off of its all-time high. If we take a look at percentage moves, we're talking about still about 14% away from its all-time high. It's in terms of a relative performance, this has not been an incredible pick for my portfolio, but I'll be happy to continue to hold this one as I feel I got a decent price around $187 a share. ExxonMobil is the only current stock that I have in my portfolio that is an oil and gas stock, and I did actually short calls against my position, and you can see shorting calls ended up being the wrong call initially, right? I shorted calls when the stock price was down here, then we rapidly jumped up in price, surpassed that strike price, but now have dropped completely back down to just at break even with my strike price. So I have shares that I own in XOM or ExxonMobil, and if we get called away from this, I'll just take a profit on the trade and collect that premium from shorting the call. Next up is Intuitive Surgical, which has been one of the most disappointing stocks that I've purchased in recent times. Take a look at ISRG. This is a robotic surgery medical device type company that I do like for the long term, but it is a very expensive stock. And when I say expensive, I'm not just talking about the $500+ share price, but rather the valuation of the company. While ISRG has some really nice growing revenues and growing profits, with also widening profit margins, the stock price at $500 a share is not only expensive in terms of the absolute ticker price, but also the PE ratio. With a forward PE of 66 and a PE at 75, this is an expensive stock. However, the story for this stock is very exciting, and I do like the idea of owning a little bit, even though it is a speculative and sort of high risk, high reward position in my portfolio. The reason I say this has been a bit disappointing is that I would have hoped that we had seen, some surpassing of the all-time highs, given the overall market has been rallying so hard recently. I'll continue to hold this one. Next up on the list is Uber. Uber Technologies has done incredibly well recently, actually trading in sympathy to the excitement surrounding Waymo and Tesla. I believe that the exciting story here recently for Uber was actually a collab with Google's Waymo, bringing self-driving stuff to various cities across the nation. So some exciting stuff happening in the self-driving world, and Uber, I think, is going to be a winner in that story as well. I do own 200 shares. This one is a stock that I'd actually like to add shares to. If we get a market pullback, if we get some sell-off in the stock market, I will probably look to add some shares to my Uber position. Next up on the list is Meta, which is another stock that has done really well in the bounce back here, and another one like Google, a big advertising giant. Meta is a long-term hold for me that I definitely would like to add more shares on anytime I can get some sort of dip in the market. I'm sitting on 60 shares here. I'd love to get that up to 100. Preferably would wait for a dip before adding any more though. My position in the DAX is an active trade that I talk about on my other channel, Trader Nick. Same goes for my position in IWM. That's a Russell 2000 position that I'm trading. That's an active position that I'm trading currently in the market. Next up is Salesforce, and this has been another sort of disappointing one in my portfolio. It's not really done a whole lot, but I do like the idea of any sort of software company that benefits from AI, and I think that Salesforce will be a winner in all the AI stuff, helping companies to more efficiently take on things like AI agents and all sorts of ways to continuously improve their businesses. Although Salesforce is also a expensive stock, but I do see a lot of potential with this name. Another stock on the list here that I own is PayPal. I own 400 shares of PayPal and would actually like to add more to it. This is a stock that looks, in my opinion, really poised for some more upside. A previous darling on Wall Street, trading at one point, if we go back on the monthly chart, you can see we traded up to $309 per share at one point. We've come down dramatically, and I do think with it, the expectations for PayPal have also dramatically decreased. PayPal has rising revenues, rising net incomes, and rising profit margins, and the valuation on the stock has come down dramatically. Take a look at the green line over time, coming down from the 40s into the 30s, and now in the teens with a forward PE of around 15. In my opinion, this is a profitable company that I think has plenty of potential to grow from here. My goal with PayPal is to get up to, 500, 600 shares on this position. Lulu is a stock options trade that I've placed. Let me show you what this is doing. This is one that's not going so hot for me. I shorted puts on LULU, and you can see it is likely that if the stock continues to push lower, that I will get assigned at $250 per share. What this means when I shorted a put or sold a cash secured put is I am essentially offering to take the bet of someone else who wanted to bet that LULU or Lululemon would continue to go lower. I think this stock has some really great, really strong brand awareness, and that people love shopping at Lululemon. This is a stock that is definitely not cheap, even with the major sell-off, but I do think will be, a household name, especially for ladies who love shopping there for years to come, and men for that matter. So by shorting the put, essentially I am selling someone else a bet that the price of Lululemon or LULU would be above this 250 strike price by the expiration date of July 11th. However, it's looking like the person who bought that bet from me is currently looking like they're potentially going to be right about the stock price being below that point. And so I sold that bet, and my end of the bargain is that if I was wrong about this bet, I have to buy the shares from that person at $250 per share, despite where the stock price could be. So let's say it's way down here at 200 per share. I would still have to buy the shares from the put buyer at $250 per share, resulting in a loss for me. Next up on the list is Fortinet, which is a cybersecurity company, which I love the space of cybersecurity. I think it is kind of value tech in a way. I think companies, municipalities, government, individuals will all need to continuously spend more money over time on the defense of this new, generation that we're living in of AI and all sorts of dangers online. Cybersecurity stuff, it plays a really important role for everybody on planet Earth. And so in my view, stocks like Fortinet, which are expensive stocks, are valued expensive because markets know there's going to be huge demand for these stocks for many years to come. Next up is Airbnb, which I shorted a call on here. In this case is actually was a really good play here. You can see I'm up almost $700 selling a call against the 200 shares of Airbnb that I own. Essentially what happened is I sold the calls when the stock price was up, and we have since then come down in price, making it so that those calls that I sold are now worth much, much less to prospective buyers. So I could theoretically take profits on this, but I'll probably let it run till expiration and collect the full 100% gain on this position, which amounts to around $740 or so. So overall, Airbnb is one that I plan on, kind of like Delta and Apple, just selling calls until I get called away on this position. Travel stocks in general were a bounce back trade for me. They were not necessarily a forever investment. And so Delta Airlines, I also sold calls on this one here at $55 per share. And with the stock price moving back down, you can see that my position on Delta Airlines, the call that I sold, is now up about 69-70% of max value. I'm floating $500 of a possible like $730. My plan on this one is also to hold until expiration date, staying short the calls that I sold. I'm still owning 600 shares of Delta at this time. If we do get another stock price bounce, I will look to sell calls again. And saving the best, or maybe the most controversial, for last, let's talk about Tesla. So Tesla is, of course, a very big size position in my portfolio that I have well, at this point, I have 400 shares of Tesla, and that's looking unlikely to change at this time because the calls that I sold, while they looked like I was going to get called away when the stock price was jumping significantly, were down again today for 2 days in a row. And so the calls that I sold are now actually back profitable, up about 35% of max profit. I do actually want to get called away from Tesla for half of my position. So I'm selling 2 out of a max possible 4 covered calls on my portfolio. Because I own 400 shares, I'm selling calls, 2 calls against essentially half of my 400 shares. So I want to diminish or decrease the size of Tesla in my portfolio because it has grown to be so much more. My initial entry on Tesla is somewhere around this area, around 225 to 230 overall. I hope this was helpful to you to break down all the stocks in my portfolio and to maybe get you thinking about the stocks that you personally own in your portfolio. If there's a stock you'd like me to cover in a future video, make sure to drop it in the comment section down below. And if you made it to the very end of this video, thanks so much for supporting my new stock market channel here. If you leave the word "end" in the comment section down below, I'll heart your comment and just let you know that I really appreciate you watching my new channel here. Thanks so much for watching. We'll see you next time.